So you can see here that at the last time we were at this open interest number, we were slightly above it here. So this is the last time in late 2023. This was the price of silver back then. It was about 22 maybe, or $23 maybe, something like that. We haven't been anywhere near there since. It hasn't ever gone below that since this number in open interest was hit. And we can see here that we almost hit the open interest here. We were slightly above it at that point, but even in this neighborhood, it only hit that price again. Silver only hit that price again one time below 30 in April of last year. And ever since then, it's been flying off the hinges. And it looks like we've bottomed over here at about 66 or 65, whatever that candle was, and now we're back above. One of the reasons why I'm calling the bottom in the silver price, this is silver open interest. It says here 134,620, but this is on a one-day delay. The actual CME numbers are now 126,789. There was a huge drop from yesterday, and I'll show you exactly why that is. It's about 8,000 contracts, a little bit less than 8,000 contracts fell off.
Silver markets are once again showing signs of deep structural stress, and according to Rafi Farber, the recent price action may be revealing more than just short-term volatility. Despite conditions that normally push silver lower, the metal has continued to hold firm, refusing to break decisively to the downside. Key indicators such as falling open interest, unusual contract roll behavior, and persistent backwardation all suggest that physical supply is tightening while paper short pressure is beginning to weaken rather than intensify. Farber argues that what we are seeing is not a typical corrective phase, but a market where the usual mechanisms used to suppress price are becoming less effective. In normal conditions, large participants roll futures positions forward month after month to maintain control of price through the paper market. However, with backwardation making these trades less profitable, that incentive structure is breaking down. Instead of smoothly rolling positions, traders appear to be closing contracts outright, leading to a noticeable decline in open interest and signaling that short positions may be exiting rather than reloading. Now let's hear what he about to say.
This is the first chart I wanted to show. It's kind of lopsided. I made like diagonal rectangles here, which isn't exactly legitimate because it doesn't track a static time period. You need vertical lines for that, but whatever, who cares? Anyway, from somewhere around 1990 to 2008, you can see monetary stability here. This is the gold CRB ratio. How many ounces or how many baskets of CRB index, which is the commodities index, can 1 ounce get you? 1 ounce of gold. So this is the higher this is, the more valuable gold is relative to all other commodities. So here we see from 1990, it goes below before 1990, from about, not, let's say 1985 or so. 1990 to 2008, we had pretty good monetary stability. Gold's value was stable relative to a basket of other commodities. And then from 2008 until about 2020, you see that things have started to get a lot more wobbly over here, right? And slowly the other commodities were degenerating in favor of gold, which means that gold was getting more expensive and other commodities are getting cheaper in real money terms. This is when credit gets less and less valuable and money becomes more and more valuable because they're printing credit too much. And this is what happens. And then you see extreme monetary stability over here from about 2020 to now. This is not normal. It should never be this way when credit is even relatively stable, which it is not at all. You can see the monetary instability is getting worse and worse, and it's going to just fly completely out of control in the end game. We're almost there. One of the reasons why I'm calling the bottom in the silver price, this is silver open interest. It says here 134,620, but this is on a one-day delay. The actual CME numbers are now 126,789. There was a huge drop from yesterday, and I'll show you exactly why that is. It's about 8,000 contracts, a little bit less than 8,000 contracts fell off. So you can see here that at the last time we were at this open interest number, we were slightly above it here. So this is the last time in late 2023. This was the price of silver back then. It was about 22 maybe, or $23 maybe, something like that. We haven't been anywhere near there since. It hasn't ever gone below that since this number in open interest was hit. And we can see here that we almost hit the open interest here. We were slightly above it at that point, but even in this neighborhood, it only hit that price again. Silver only hit that price again one time below 30 in April of last year. And ever since then, it's been flying off the hinges. And it looks like we've bottomed over here at about 66 or 65, whatever that candle was, and now we're back above 90. I don't think we're going to go below this bottom. I don't even think we're going to go below 70. I think the correction is done. Here's another reason why. So the 126,789 contracts I showed you in this chart over here, where this little black line is, and I drew it in over here so you could see it. So this is the COMEX tables, the CME tables of what happened in silver trade yesterday on the futures. So you can see March silver over here. This is the active contract. It is rolling off and it's becoming spot in the next two trading days. So because today's the 25th, so we have the 25th and 26th, and the 26th would be the last trading day of this contract as a futures contract. So you've got to roll out of it. You've got to roll to the next contract in order to keep your futures position. Otherwise, you risk delivery. So what is happening here is that 14,196 contracts closed out, meaning those shorts were bought back. Those contracts no longer exist. And usually you'd see a similar amount or even a higher amount rolling into the next active contract to maintain the futures position. But here we had 14,196 closed out and only 5,350 new ones opened. So a lot of positioners, whether they are bullion banks or whoever they are, that had these contracts long, they closed them out and they didn't roll them over. Why didn't they roll them over? Well, if they're a bullion bank, they can't do it profitably because the price of London spot silver is still higher than New York futures, and it's been that way on and off since October 9th of last year. Bullion banks cannot provide liquidity in this market because they cannot profitably hedge. It's been that way for almost 3 months. Or is it 4 months? October, November, December, January, February, 4 months. Over 4 months, it's been that way. Hey guys, Rafi here from the Endgame Investor, and this week's silver report, we're going to go into why it is very likely that silver has bottomed here at $66. We're not going to see anything lower than that. We're seeing it in the backwardation. We're seeing it in the open interest. We're seeing it in the reaction to the tariff smackdown by the Supreme Court. Silver should have gone down, but it didn't. And we're seeing it in the lack of rollovers from the active contract to the next active contract because of the backwardation, which prevents bullion banks from going short silver in New York and going long in London because that is not profitable. And so they run out of the New York futures, and that enables price to move even higher. This correction was very short-lived. It appears to be over. We're going to go into exactly why, and that it's been 5 years since the Fed's favorite inflation indicator, the core PCE, Personal Consumption Expenditures Index, has been below 2%. It's been 5 years. They've been over target for 5 years. Remember symmetrical inflation? Symmetrical inflation. I sound like Chinese. Symmetrical inflation, that rationalization or justification for the personal consumption expenditures core measure to be over 3% or over 2% for a symmetrical amount of time so that it compensates for when it was under. Well, I wonder if we have to be below 3% or below 2%, whatever the target is, symmetrically in order to even out the inflation indicators. Of course, that's not going to happen because the Fed has already lost control. They can't get their inflation indicator down to where they want it to be. It's over already. It's just watching the dollar die now.
Rafi Farber argues that silver has been showing a rare and important market condition called persistent backwardation since early October, which he believes signals a deeper structural shift in the precious metals system. In simple terms, backwardation means physical silver is worth more than futures contracts, which is unusual and suggests that real metal is becoming harder to source compared to paper contracts. For more than 4 months, bullion banks have struggled to profit from their normal strategy of hedging between London spot prices and New York futures. Because that arbitrage trade is breaking down, their ability to provide liquidity and smooth price movements is weakening. Farber explains that every time silver sells off, backwardation quickly returns, which he sees as a strong sign that physical demand is still outpacing supply. Instead of resetting the market, each dip is being met with renewed tightness, suggesting that available metal is not as abundant as the paper market implies. He warns that if this condition becomes permanent, it could eventually spread to gold as well.
SLV is being used for quick trades. I just want to show you what's happening here, what has been happening since the silver crash of 2026, of January 29th, 2026, what happened in SLV. So you saw here, here's the crash of the silver price moving from about $110, $120 to about 70 in a day, whatever it was. It was a huge 120 to 70. Wow, that's like $50, $50 in a day or two. Oh my gosh, that is nuts. So we were all waiting for silver to hit $50 for like since 46 years, and then all of a sudden it didn't. It fell $50, and it's still at like 90 now. Okay, whatever. But you see here, the total metal in the trust went way up on January 29th. I think this is the third biggest influx of silver behind one other day in 20 something and silver squeeze in 2021. But this is a huge day of about 35 million ounces of silver flooded in on that crash, and that was bottom pickers, right? They were buying SLV because they wanted to. They saw that the fund would probably jump up as the huge crash would be corrected somewhat. And you can see here, since they did that, since they bought silver on that day, and then silver had to be flooded into the fund because of all those bottom pickers. But then you see, since then, silver has been drawing out of the fund as these traders have sold their shares for that quick bounce. And it looks like they might have gotten a few bucks on that, and good for them. But there's no sustained interest in SLV here. It's just the retail crowd is still dead. There's no interest in this ETF, it looks like. That was just bottom picking. The Fed's favorite inflation measure has been above 2% for 5 years straight now. I highlighted the last time when the 2% mark was last, it was last underneath the 2% mark. That was February 2021 at 1.709%. This is the core PCE, the most manipulated of manipulated inflation measures of consumer prices. We are still above 2%. I think we're at 2.8 or 2.9 or something like that. And we had a little bit of a jerk up here, a move up here. So it looks like these statistics are accelerating again. It's been 5 years, okay? We haven't been above 2% for 5 years at all since, wow, since like from 1960 something to 1991. Some 92, 93. Wow, we were above 2%. So you can see, that opens up another topic of concern, that this inflation indicator was above 2% for like, what is it, like 25 years? For a quarter of a century, it was above 2%. Was the Fed doing their job then? No, because they never do their job. They can't do that. Their job is to print money. They do that very well. That's their actual job. Their job is to inflate, not to stop inflation. Their job is to inflate. And that's what they do. So they're accomplishing their mandate of inflation. That's all they do. There's nothing else that they could do.
According to Rafi Farber, silver is exhibiting a peculiar and enduring situation known as backwardation. To put it simply, this implies that actual silver is more expensive than silver contracts in the futures market. This is significant according to Farber, since it implies that bullion banks are having difficulty carrying out their regular responsibility of maintaining market equilibrium. They often earn from hedging between paper contracts in New York and actual silver in London, but when backwardation occurs, that transaction becomes unprofitable. They are unable to supply liquidity in the typical manner as a result, and this interruption has persisted for several months. Farber emphasizes that the fact that backwardation is occurring and that it continues returning after each price decline is what makes this situation concerning. Every sell-off is followed by the same physical supply tightness rather than the market resetting. According to him, this implies that the paper market is no longer completely controlling the price of real silver, and that demand for it is growing faster than supply. He cautions that if this condition persists in silver, it may eventually affect gold as well. Physical metals routinely trade at a higher value than paper promises, which he takes as a symptom of severe stress in the dollar-based monetary system. In his opinion, that would signify a serious breakdown in the system. Thank you for watching and see you in the next video.